Hello, everyone. Welcome to the webinar today. We are so thrilled to have you with us talking about real estate investment and tax strategies. We're looking really at the top strategies for this year, particularly. And so we've brought on with us today Nicole Green. She is an enrolled agent with Robert Hall and Associates. And I'm going to hand it off to her in just a moment. But before we get started, a few reminders. We are recording this entire webinar, so if you miss anything or you want to share it or play it back later, we'll send it to you tomorrow. And then we're also going to email you Nicole's contact information and the slides, so you can get in contact if there's any other questions that you have. However, we will have some time for questions at the end. So please put your questions in the Q&A box, and then whatever's in there, we will be able to then send over to Nicole and her team so that they can answer your tax questions. Offers here that we'll go over at the end. But for now, I'm going to hand it off to Nicole to get started. Thank you, Nicole, so much for coming on to the webinar to talk to our group.
Of course, of course. Hello, everybody. We get to talk about our favorite topic, taxes. Taxes are so much fun and a wonderful thing. I want to take a minute and first introduce myself. My name is Nicole Green, as already stated. Before I got into taxes, I was in education. People think it's completely different than taxes, and it's really the same thing. We're constantly learning in this tax world and constantly educating people in the tax world itself. And this year, 2025, is going to be a wonderful year of learning and understanding a lot of new changes, because there will be a ton of changes coming up, and it's going to be a great opportunity for people to take advantage of these changes and really use your tax returns as a tool and not as like this dreaded thing where you're getting crumpled by, I don't know, the man or whatever. I work for Robert Hall and Associates. Here are some of the senior tax consultants and our wonderful set of team. Robert Hall and Associates has been around since the 70s. We believe strongly in valuing our clients and helping advise clients. We do tax strategy and tax advice. Of course, that does mean that we file tax returns, we do incorporations, we do payroll, we do all of these things, because we want people to be able to take the strategies that we come up with our clients and implement them. Being philosophical and hypothesizing is not something that we are about. We like it for people to really take advantage of their tax returns and use it to support their goals. And so if we don't do it in-house, we have a huge referral network that is able to help and get people the things they need to do. One of the amazing things that we offer at Robert Hall and Associates is a free 30-minute consultation. I love talking about tax. I'll talk about taxes for days and days and days. That is something I totally don't mind doing. But when people ask me about tax, I always have the first question: how much? How much money are we making? How much money is coming in? What are the deductions? I'm always asking that. And sometimes, you're not really in the ideal place to be able to answer said questions, because I get people that ask me these questions at the grocery stores when I'm out to dinner with friends and things like that. And again, I don't mind, but it might need to be a little bit more private. And that is one of the great benefits of having these free 30-minute consultations. We can see just the strategies we think to see for you. Is that really something that's going to work for you? Sometimes people just have a general question, and I understand it's mechanics, doctors, lawyers, and accountants that, like, when you find somebody that's in that profession, you're like, wait, I do have a question, because a lot of times it's very difficult to get a hold of these types of people. And so we welcome people to sign up for a free 30-minute consultation. You can email me if you have a general question as well. Nicole.green@Robert Hall and Taxes is a wonder. You can use my email at any time. So before we get into things, I want everybody to know I am licensed by the federal government, the IRS specifically, and I'm giving educational advice about taxes and not about real estate. I'm not an agent. I'm not a broker. I am only about taxes, and I definitely understand how it affects everything. Okay, let's get into it because we are on a little bit of a time limit here. So when you have the ability and the pleasure of having income that is not W-2 income, you get to write things off. Writing things off is so ideal. It is a way to reduce, obviously, your tax liability. And so what can you write off? What is it about? The way to think about your write-offs is very simple. Am I using it for business? If I'm using it for business, regardless of how you're structured, you are going to be able to write it off. And that's one of the beauties of this whole tax code situation. Different structures will determine how the thing is getting written off. And so you do need to think about that a little bit later on, and we'll talk about the different structures and when should you change to a different structure, or when you should be at the perfect type of structure for you. But first, when you decide that you are going to have some income that goes for yourself, you need to open a bank account for that so that you can track how much income comes in, and then also all the expenses that go out. And all those expenses should be solely related to that business. Partially or 100%, all of it's going to go through that business account. And so then later, you're easily able to understand how much is spent on it. Like something easy, think about it like internet, right? You're using your internet partially for business, and obviously you'll use internet partially for personal. Depending on how you're structured will determine if we can take that full amount as a deduction, or do we need to have it parsed out and split it. But we should still have the internet go through the business account, so then at the end of the year you're able to make that call. So generally, don't overthink things. If you're using it for business, have it go through the business account. And then if you have things that are not used for business, have those go through your personal account. You can transfer from business to personal at any time and personal back to business at any time without worrying about it affecting your taxes, as long as you're not a C Corp. A C Corp will change that, but most people aren't going to be C Corps. When we're in the real estate world, there's a wonderful thing where we're talking about depreciation, bonus depreciation. It is so great and so helpful for people that want to utilize it. Depreciation is where you take the value of something like a house or a car and you spread it over an extended amount of time. That amount of time that it is spread over is already predetermined. I don't get to decide it. Another accountant's not deciding it. You're not deciding it. It's already predetermined. For example, a residential property. It's going to be spread over 27 and a half years. That is predetermined. Bonus depreciation is where you get to accelerate that depreciation. You get to move it forward over into either 1 year or 2 years or even 3 years. And that allows you to take a larger amount of a deduction up front. So if we purchase a property, for example, we purchase a property and we have, I don't know, $300,000 of depreciation. That $300,000 being spread over 27 and a half years only gives us a little bit of depreciation each year. However, I may need to take a larger amount of it, or I can take a larger amount of that depreciation in the very beginning when I first put it into service, having bonus depreciation. And then you can have a larger deduction. That larger deduction will allow you to have less of tax liability. Less tax liability means you can do more things. We take that tax liability and we go reinvest it into another rental property and keep doing this cycle. We can really grow our portfolio. To be able to accelerate that depreciation in a residential property, you need to do what is called a cost segregation study. A cost segregation study is when you basically are itemizing everything inside the house. The residential property is spread over 27 and a half years. But if I go in and I say, well, there's windows, there's a refrigerator, there's carpet, there's paint, there's $40 of doorknobs, like, and I go through and I itemize all of that, then all of those different things have their own life. They don't all have that 27 and a half years. The windows are at 15 years, the carpet is at 1 year, the doorknob is at 5 years. They already have their own predetermined lifespans. And so then with things that are at 1 year, obviously 5 years, 10 years, and 15 years, you're able to accelerate. They qualify for bonus depreciation. This is why you hear a lot about people talking about, like, oh, if I have a car that's over 6,000 pounds, I can use that as 100% depreciation. And you don't get it as 100% anymore, but that will most likely come back, because a car is at 5 years of a lifespan. And so if you buy a car and is eligible for bonus depreciation, you're able to accelerate to take all that car value, as much as you spent on the car, regardless if you paid outright or you financed it, you're able to take it all in one lump, helping you reduce your tax liability. Now, let me give you an example of somebody that did that did a cost segregation on a real estate property. Here's their federal tax summary, right? And so in the federal tax summary, we can see that they have a rental, and this rental is showing profit. Maybe it's multiple rentals, etc. And it is showing profit. $33,000 of profit. They also have W-2, and so they are looking at a tax liability of $20,850, and they owe at the end of the year. On the state side, their tax liability $8,111, and they're also owing on the federal, they were owing about $4,000. On the state, they're also owing about $4,000. If they do a tax summary, if they do a cost segregation, that cost segregation, going through itemizing, they accelerate that depreciation. That $33,000 of profit has now reduced down to $11,000 of loss. That was like $40,000 of usable depreciation that they were able to use. That has changed things for them entirely. Remember, on the federal side, they had $20,000 of total tax. Here, they have 11,600, it's like 20,800. Here, they have 11,600. Not only do they not owe on the federal side, they're getting that $5,000, almost $6,000 refund. On the state side, we're looking at 2,400. Again, they're not owing anymore. They were owing about 4,000, but because of this cost segregation study, they now have a refund of 1,300. When you do these things, when you take these costs, this tax savings, it's a great and it's amazing, absolutely wonderful thing to do. You should do them for further investment, for further growth. I always tell people that cost segregations are great ways for people to triple, quadruple their portfolios in very short amount of times, because you purchase a property, you do a cost seg on said property, then you have the tax savings, and the tax savings don't come all out in 1 year. The first year is when you get the big hunk. Then the next year you also get another little hunk. So maybe it takes 2 or 3 years to do some savings. You just save the tax savings. Save the tax savings, and then 2 years later, or 3, maybe 1, I don't know, you go and purchase another property, do a cost seg on that one. You take the tax savings again, and it's just rinse and repeat, rinse and repeat. Later down the road, yes, because we have taken all the depreciation out of the properties, our tax liability might be a little bit higher, However, we just quadruple our portfolio, and so we have a whole different issue to worry about and a much more pleasant issue to worry about. And then we can deal with other ways of tax savings, because cost savings are not the only way to save on taxes. There's many, many other ways to save on taxes. Now, something that people are always very, very concerned about is audits. They're like, oh my God, am I getting audited? I don't want to get audited. I don't want to trigger an audit. How can I make sure that I'm not triggering an audit and getting caught? I understand an audit is an awful experience to go through. Even at the end of the day, if it ends up being a no change audit can definitely be a stressful experience. One, because it is a very slow process, very slow process. So let's talk about some ways that we can avoid triggering or making an audit. There are some key things that we see people do that make it look like you're not telling the truth. When you are maximizing your deductions, when you are utilizing your deductions and you're thinking you're going to be audited, you need to look at your ratio. It's all about ratio. The IRS and the state agencies, they know what you are doing. They know if you're in real estate, they know if you're a doctor, they know if you're driving Uber, they know, because you have to identify that, whether you're doing this on your own personal return, whether you're doing it in a partnership, a single member LLC, you're identifying what that business does. And when you identify what that business does, they just look at averages, because your deductions need to be, all deductions need to be ordinary and necessary. The ordinary means, are you normal? Are you part of the average? And when you have things that are not part of the average, that causes the government to go, I wonder. Let's ask questions. I want more information, which doesn't mean always be the average, but let's make sure that when we're not the average, we make it worth it. We don't want to do something that's not normal or ordinary for a $500 tax savings, because that can, of course, trigger an audit. If we're going to do something that's not normal or ordinary, then we want to do it for, a $15,000 tax saving. It needs to be worth it and significant, so that the value of itself will make up if there is an audit that happens. Because an audit doesn't mean you have to give that money back that you did the tax saving. An audit, lots of times, many times, an audit is just giving them paperwork, waiting, more paperwork, waiting, more paperwork, waiting, and then, okay, nothing, no change audits. Those happen all the time, but it is an annoying process to go through. So we want to make sure that our clients always understand the value of the actions that they are doing. And if it has a small value and lots of risk, why are we doing it? It doesn't balance out. But if it has a little bit of risk, or some risk, or even a lot of risk, but the value is there, then we say, let's go on and do it. Let's talk about some things that really just kind of go boop, 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 boop. This is not going to fly. One of those things that that people will consider red flags for audits is excessive credits or deductions compared to income. And this is what I was talking about when I was saying you need to make sure your income and your deductions balance each other out. If you are on a Schedule C and you have $10,000 of gross income that's before expenses, and then you have $50,000 of expenses, the government is definitely going to be like, is this a business or is this a hobby? Does this make sense? If you have a little bit of income and you're taking losses for years and years and years on your personal return, again, the government's going to be like, this is not a business. And so you need to be proportionate about things. Yes, businesses take losses. Losses are fine. Losses don't trigger audits. It's proportionate. How much of it? If you're bringing in $1 million and you have $2.6 million of expenses, so you have a $600,000 loss, okay, that happens. That can easily happen, but you're bringing in 1 million. How long have you been in business? It all is proportionate. Obviously, if we're bringing in $1 million, we're not on an individual return. That would not be great. Another part of this is excessive credits. The government does not mind approving credits. We saw this with COVID. How many people were getting PPP loans, stimulus, like EDD loans, employee retention credits? There was free money going out everywhere. Government was like, boop, 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 boop. Here's a bunch of free money. Here's a bunch of free money. And then several years later, the government's like, excuse me, we kind of want our money back. Let's talk about that. And that constantly happens. When you get credits, that's the government saying, I know you owe me money, but you don't have to pay this specific amount because of whatever reason. Of course, they're going to look into that continuously. Missing and underreporting income. This is huge. We're the only tax system in the first, out of all the first world countries, that has it where other people report the amount of money they gave us, and then we fill out a form saying, yes, I received this amount of money, and here's all my deductions. And the IRS goes, are you lying? Do these things match? And when we don't have the amount of income that they have, they are going, you are lying. You need to talk to us, i.e., there is an audit. Underreporting is one of the worst things that people can do. And also, it really hurts people. Several times you'll hear people go like, oh yeah, I had this ADU, but I don't want to talk about it because I don't want to report the income because I don't want to pay tax. And I'm like, you're actually hurting yourself because we're going to depreciate the ADU. We have to, it's not an option. We're going to depreciate the ADU. Now we can throw in your gardener expenses. Now we can throw in the cleaning. Now we can throw in all of these things. This ADU is actually going to produce a loss. That loss can help you go against your other W-2 income. Like, so not only are you hurting yourself, but you're also more than likely triggering or making it a little bit more likely for you to be audited. Make sure you're reporting your income accurately. I know sometimes people get a little irritated about all the forms that people have to get. And they're like, oh, what a big deal is it for me to get my interest, my 1099 INT, my interest from the bank? It's only like $110. Who cares? The government cares. They want it down to the dollar. And they have the information, and you need to match what information they have with what you are reporting them. And the other part of this is refundable credits. We already talked about how credits can obviously trigger an audit, but there's refundable credits. Not only does the government say, okay, I know you owe me money, you don't have to pay me this amount of money, but a refundable credit means if your tax liability goes down to zero, meaning you don't owe any tax, they will give you the amount of that credit. And so if I have a credit, a refundable credit, and it is $4,000, and my tax liability is $3,000, because that credit is refundable of $4,000, it will take away all $3,000 of my tax liability, and they will give me that additional $1,000. The government hates giving people money. Hates giving people money. You can understand this if you've ever gotten a refund on your tax return. It takes forever for you to get your refund. And so if we're getting a lot of refundable credits, you're going to see the government taking extra time before they release that money. It definitely triggers audits. The next thing, round numbers. Nothing costs $20. Nothing costs $175. Nothing costs $300,000. Nothing ever costs that. One, because there's sales tax. Two, because it just doesn't. That's not how people think, price things. That's just not how it is. And so if you're saying, oh, my utilities are $2,500, that's not true. The government knows that you're not going in and finding the accurate information. You did not go and look at the receipts. You are not telling these things all the time. And so they say, if you're not doing the work, we will make you do the work because we think you're overestimating. They don't believe you. And that does make sense because you're not doing the work. And so you are guessing, and they don't want you to guess. They require you to go find that information. So credits, deductions in terms deductions in comparison to income, meaning your deductions are really outweighing your income, underreporting or incorrectly reporting things, or refundable credits, which is really the same thing as credits, but the refundable ones really, really, really round numbers. These things just spark the state agencies and the federal government's eyes, the IRS, and go like, this stuff is not accurate. Now, let's take a second and talk about the different types of entities and who is getting audited the most. And let's talk about why. Partnerships are going to be about a 0.1%. S corps also are going to follow about a 0.1%. C corps are going to balloon to 2.9%. And then personal returns go all the way up to 0.38%. Why is this so out of whack? Let's first start with C corps because that seems to be the anomaly. C corps is the entity where you do not pay tax. The corporation pays all the tax. If you take money out of the corporation, you will pay tax on your personal side. But if you leave all the money inside the corporation, if you leave all the profit inside the corporation, the C corp will pay its own tax, and it's a flat tax. Sometimes when people are set up as C corps, it's actually very, very common. They find ways of taking money out of the corp and not reporting it the way they're supposed to. It's very common. A lot of loans to shareholders, a loan isn't taxable, but it's not a real loan. Nobody's paying interest. It's not notarized. It's actually not a loan. It's just you taking money out of the C corp. And thus the government knows this happens quite frequently. The government is very aware, and so they go in and audit this quite high. The next ones that we've got personal returns, S corps, and partnerships. Partnerships and S corps, they're all pass-through entities, meaning they don't really pay tax. In certain states, you pay a little bit of tax there and there, but it's not really a tax on income. It's just kind of like paying to have the corp or the partnership. But personal returns are where everybody pays all of their tax with partnerships and with S corps. Now, partnerships and S corps, if you ever had one or if you ever have filed one, you know people charge more for filing that than a personal return. Why? Because there's more information that needs to be given. There's more work that is involved. I have to balance a return on a partnership and a corporation, meaning I have to show the income coming in and the income going out, how much is left and how much you took out. On a personal return, there is no balancing. There is no way. And so when things happen in S corps or partnerships that are a little extreme or a little intense, like maybe we bought a really large amount of equipment, I can show that easily so that it's well and clearly defined inside an S corp and a partnership because there's spaces for me to do that. If you're on a Schedule C or a Schedule E, there's no extra spot for me to do that. And it's not like you can attach things to the tax returns and be like, I know that this might look weird, or I know this might look intense, but here's the information to back it up so you don't have to ask the question. I can't do that. They don't accept that. The government doesn't accept that. And thus, partnerships and S corps are audited less than personal returns. In addition to that, personal returns is where you've got people like Uber drivers or just everyday people just throwing things to the wind because that's where they see the tax. During COVID, so many people I'm going to use business use of home, even though I work for Chase. And it's like, your business is not using home because you don't have a business. So there is no business use of home. You need to go talk to Jamie Dimon Jamie Diamond's business is using your home. And if you want to be reimbursed for that, go speak to him. But you don't own Chase. You aren't Chase. You work for Chase. So you don't get business use of home deduction. But there's so many people just trying to do these things, working. I'm doing side hustles, and now I'm taking, $30,000 losses on my side hustles. And the government's like, no, 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 no. But where does all of this stuff happen? It happens on personal returns. Because remember, everybody's filing a personal return, and that's the same as the people that go to H&R Block, TurboTax, and then spend, $2,000 on accountants. We're all doing personal returns. I'm doing personal returns. But we have to put all of those together. And how many times are people doing crazy things that, yes, the people that spend the $2,000 on accountants wouldn't do, but they don't know that. And so the other people are also combined in there as well. And so you need to understand, depending on what is happening in your business, depending what is happening, you should determine, is it advisable for you to look at your entity structure? What is the way you should be structured? I spoke earlier about refundable credit. Refundable credits and just credits in general, a lot of times happens for people with lower incomes. Thus, you can see incomes under 25,000 are constantly getting audited. Again, these are the people that maybe even aren't going to H&R Blocks or TurboTax. These are the people that are just doing like the free filings or trying to file all on their own, right? They don't have the money. If you got 25 a year, you definitely, I mean, I guess that's really only, I guess it's like more like $40,000 a year, but whatever. You don't have the funds to spend on an accountant. And so you don't maybe have the knowledge of the things that you're able to do, especially because the tax code changes all the time. I mean, that's why I find it to be fun, because it changes. Also, people with income over 500, why are they getting audited all the time? They do have the accountants that are going to do things because they do stuff. They do stuff. And the audit is totally fine because they've already gone and planned for the audit. These are where we see the no change audits. Because if you're having $500,000 of income, the amount of tax you are paying if you don't do stuff will make a grown man cry. So you need to do stuff because we can't be paying all that tax. That's absolutely not. And you also have the funds where you're able to pay people to help you do these things, and you have the other types of investments. And so, one, I really want people to understand that where you lie in terms of how likely you are to be audited, but also, I want you to understand that an audit is sometimes just what it is. And if it's going to come, and if you're going to increase the risk of it, maybe it doesn't have to come, but just increase the risk of it, let's make sure it shows value. Let's make sure the tax savings is worth it, because you can have some pretty significant tax savings. I want to address the major types of deductions that we see people taking, so you know how to be including in your deduction. So you're understanding, like, am I normal? Am I not normal? Is this crazy? So marketing and advertising expenses. This is going to be high. People in the real estate world, specifically people in the real estate world, have to market themselves, have to market their properties, have to market everything online and in person. There is so much that goes into advertising. Me as a landlord, when I have new tenants that are coming in, or the ones that are leaving, I have to put up ads. I have to pay for these services. I have to get brokers to help find tenants that are coming through. Like, there's all of this that is happening, and that's a normal thing. I even put up posters in the actual streets sometimes. This is normal. And so these marketing and advertising expenses are going to be significant. It's definitely one of the top deductions. Professional supplies and equipment. Since COVID, people have embraced the online world and working from wherever you need to work from. You work from home. Sometimes people work in cars. Sometimes people work in cafes. Sometimes people have offices. I'm here in my office at work. I have a home office. I also have the ability to work anywhere I need to. And that means I bought stuff. I have computers in all of these places. I have laptops. I have supplies. I have equipment. You're still buying paper. We're still buying pens. We're buying calculators. You're buying all of these things. And so these types of equipment are going to be much, much larger than what you would just generally imagine. Car expenses. Car expenses are a huge deduction. I'm here in California. In California, we drive significantly more than the average American. The average American is driving roughly about 10,000 miles a year. California, we're about 12,500. We are significantly more. Thus, our cars are also usually significantly more. Your car expense is a great and wonderful deduction, and also sometimes higher. Remember, if you're taking miles instead of car expenses, you need to compare the two because the miles rate is determined on a national average, and your personal expenses might be higher than that. And so you don't have to take miles. You can take straight expenses. It's either one. Which one is the larger? It's just the same thing like about itemizing, right? You can take the standard deduction or you can itemize. We figure out both and we pick the larger of the two. That's the same thing you should do for your car expenses. Gas is astronomical. It's through the roof. The amount you bought your car for, you leased your car for, that is astronomical as well, especially now. The repairs that need to be done with the car washes to maintain all the things that you've done with the car, the additions that go into the cars, all of this is great, wonderful deductions that you're either fully going to be able to take depending how you're structured or partially be able to take depending on how you're structured. But it's a wonderful and huge deduction that you should not forget. Legal and professional fees. This one bothers me the most. When people forget legal and professional fees, I'm like, hello, these are great expenses that we're talking about. When I look at P&Ls and I'm like, excuse me, where's the expense that you paid me last year? Why is that not on your P&L? And they're like, oh yeah, I forgot about that. And like these expenses add up. I'm not the cheapest in the world, obviously. And so it's a wonderful deduction, but it's a full deduction. It's great. Notaries, transaction coordinators, attorneys that review contracts, legal and professional expenses. When you're hiring somebody of a specific profession, that is going to be fully deductible because you're using that person for your business. And forgetting these small things really, really add up, and they should not be forgotten because you're spending the money. And the way people need to understand this is they need to understand that you shouldn't go out and spend more money so you get more of a deductions and so that you have have a bigger tax savings. Because if you're going out and spending more money for a tax savings, the amount that you're spending is still going to be greater than the amount of the tax savings. And so that's not always the most ideal situation because we want to keep the money in our pocket. Yes, we want a larger tax savings, but we want to keep as much money in our pocket as humanly possible. And so it's not about going to spend more on the business. It's about how do I include the things I'm already spending, the things that are going to be bought and the things that are going to be purchased already, no matter what. How do I make those deductions so I can reduce my taxable income? That's how you need to think about it. Property is a wonderful, wonderful, wonderful deduction. This doesn't matter how you are structured. Oh, there's an ambulance. Sorry if you guys can hear that echo going by. Property deductions, doesn't matter how you are structured, it's going to be a wonderful deduction. Your primary residence is going to be a great deduction. Rental properties are a wonderful deductions. I just talked about cost segregations. That's on a real estate, on a rental property. It's a wonderful way to get deductions. Business use of home is a great way for deductions. I know I talked about a bunch of people using it before that shouldn't be using it, but it still is a good deduction. It doesn't mean don't use it. It just means use it correctly. If you are structured differently, you can do a rent back if you actually have a corporation as opposed to it being on your own personal return. But property deductions are wonderful, wonderful, amazing deductions that people have. I mean, if you work from home and you need to redo your stairs so that you can have your clients come into your house without having to go upstairs, or can have private entrance and exit. All of this can be taken into account. Your utilities that you're using, obviously I'm using the lights as well as personal and business because I'm working from home. Like, there's so many different ways your property can come into effect, and you really need to understand that a lot of times because there's a cap on SALT taxes, state and local taxes of $10,000, your property taxes aren't always being fully accounted for. And so there's ways that you can make those things work for you. PTE credits are a great way. Properties, fabulous deductions, fabulous investments, fabulous, fabulous, fabulous all around the board. I'm going to talk really quickly about some of the changes for 2025. Then we're going to open it up to questions because I understand we are on the crunch for the time. We had BOI, Beneficial Ownership Information Statement. This was something that came out in 2023 and it was supposed to be effective for 2024. It was the State Department, not the actual state, but the federal State Department, that was asking anybody with an EIN that wasn't a bank, that wasn't a publicly traded company, for to identify the owners, identify the location, and identify themselves, who was filing the return. Lots of people had some issues with this, constitutional issues, whatever. They went to Texas. Texas said, hold on. Then another judge said, no, you can do it. Then another judge in Texas said, actually, hold on. So right now, it is on hold. Excuse me. It is no longer mandatory. You don't have to do it. If you did do it, or if you are planning on doing it, please, for the love of anything and everything, do not pay somebody to do it. People were telling me that people are charging like $695 to do this. And I'm like, it's so easy. It's a little annoying, but it's so easy. It takes 5 minutes to do. There's no reason that you should pay somebody else to do it. You no longer are required to do it, but if it does come back in effect and you're worried that you won't be notified about when it does come back in effect and you want to do it, if, I don't know, if it will come back in effect, you can go on and still do it. It's, as of right now, it's optional to do. You need to identify the EIN, the location of the business, the owners of the business, and then you have to give your location multiple times. And then obviously you need to identify yourself as the filer. And you can go on to fincent.gov/BOI to go ahead and do it. But whatever you do, do not pay somebody to do this. It is so insanely easy. But as of right now, it is not a requirement to do so. If you don't want to do it, then don't do it. The fires, people are affected by the fires here in California and LA. They have been absolutely devastated by these fires, and people want to use their tax returns to help compensate for such loss. I am here to say right now, your tax returns are not going to be able to help you with that compensation at all. They will not make you whole. There is some things that you can do with the fires. You can take a casualty loss for if you have lost parts of the things inside fires. But before you do that, before you take your casualty loss, you need to understand how much is insurance paying. you. Because if you take that deduction and then take insurance money, that insurance money now becomes taxable. The insurance money is a major driver in what happens with this inside your tax return, because what you do with that insurance money is going to decide if it's going to be taxable or if it's not going to be taxable. If you take the insurance money and you rebuild, you have 4 years to rebuild. Or you can go buy replacement property as well. And then that money there, that's not going to be an issue. The insurance money is not going to be taxable or anything. If you take that insurance money and you leave, it is considered a sale. And you will go through normal sale process if you were to sell your home to Tom, Dick, or Harry. If it's a primary residence, you've lived there for 2 out of the 5 years, you're going to get the exclusion, $250,000 per person. So if you're married, $500,000. If you're single, $250,000. If it is a rental property, you're going to recapture depreciation. There's no exclusion. The insurance companies, the amount that they've given out without the normal type of record keeping, the different type of record keeping that is required is completely different than the government. What the insurance companies require is not going to be the same thing as what the government requires. And so when you're dealing with things with a fire, you need to treat your record keeping just like you do a business. Take pictures, keep receipts. Nothing should be done in cash. Nothing should be done in cash. Nothing should be done in cash. Take copies, scan that, throw them all up into a drive. An email stating what was being purchased, how much was being purchased, and when it was being purchased is the same thing as a receipt, as long as it's also like responded to. A text message of that same bit is the same thing as a receipt. A handwritten invoice, that works as well. Throw all of that stuff into a drive. If you've lost your house or if you have devastational amount of damage and you're in this recovery process, I would highly recommend opening a separate bank account for this. Opening a separate bank account allows you to easily keep track of all the transactions that you're using just for this. You can contribute money to that bank account and it's not going to become taxable, but you can also know how much the insurance gave you, exactly how much the insurance gave you. And so that if somebody does come around, because remember, they don't come around and ask questions the year of. It takes 3 to 10 years before they come around. And so if somebody does come around, you have all of that documentation. Every year, download a copy of all of your statements, throw them up into that same drive that you have with your receipts and your invoices and all of that and your P&Ls. Throw that all in that same drive. Don't think about it. It's there, you're safe, you're secure. And if somebody does come around many, many years later, you can easily tell them to go away because you have all the paperwork that they are going to ask, and you can get all of the questions answered easily and quickly and efficiently. And that's kind of the goal. Also, what happens on the state side is not going to be the same that happens on the federal side. California may and is still trying to offer people additional bits of relief. For example, California gave the extensions to the fires before the federal. The federal did conform, but California gave extensions for people that were accounted for in LA County that put on automatic extensions to file and also an extension to pay. That was unheard of, an extension to pay. That never, ever, ever happened. The federal government did conform, but it took a second. It took a second. And California is still trying to offer people additional bits of relief. And so what happens on the federal side is not always going to be what happens on the state side. And just for me wanting to leave you with on a little bit, is it worth it to talk to an accountant? Is it worth it to talk to a tax advisor? Yes. They will help you save money. They will help you further your goals. Your tax returns are things that follow you for multiple years. Lowering your tax liability obviously is everybody's goal. Of course, everybody wants that. But if lowering your tax liability now makes it so you can't purchase a home in 2 years, that actually was more detrimental to you. And so you need to balance it. And so when you're talking with somebody that's advising you on your taxes, you need to be talking about your goals. It's not just ways to figure out how to lower your tax liability. What are your goals? Do you need to be more liquid? Are you going to have a family member that has medical issues that are moving in? Because we can talk to you about how you can get it so those medical expenses that you're spending are now deductible, so you can at least have that as a deduction. Or your kids getting ready to go to college and you're going to pay for that. We can talk to you about ways you can set up life so that you are able to give them money and it's a deduction. There's multiple ways that your tax returns can be amazing utilizational tools. You can use them in such great ways. You just need to know what to do and talk with people. And so I highly recommend anybody that has some big changes happening here in their life, or if they're just paying a lot in tax, to talk with an advisor. And then, of course, if you guys have any questions, feel free to hit me up, Nicole.Green@Robert Hall Taxes. I would love to speak with you guys. We have some time right now to open it up to questions.
Yes, and also want to launch a poll question as well. So Robert Hall and Associates is offering a $50 off your preparation fee if you schedule a complimentary consultation. So if you say yes to this, you'll be eligible for that. So go ahead and answer that. I'm just going to leave that up while we take some questions. Thank you so much for that. Thorough. You went through so quickly, so I appreciate it. The first question here was from Sam. He's asking, I did not do cost segregation when I first bought my rental 5 years ago. Can I still do it moving forward?
So, yes, you can. Depreciation is all about the date put in service, and so that's why it's an issue. But yes, you can. There is a way that you can retroactively go grab the loss that you were to the deduction that you were to have and recoup it. However, that's a highly scrutinized way of going about it. And so you need to understand how much is the rental, how much of the cost sake would have been accelerated in depreciation. And if your rental was like, let's say the rental was like $1 million, that's not going to be enough. It won't be enough to make it worth it. You need to now focus on buying another rental and doing it then.
Got it. Raquel was asking in the chat if she's going to get the slides and the recording. So I will be sending that out tomorrow, as well as Nicole's information here, which is on the screen. So no worries there, everyone. Also, Tracy asking, are there limits on what I can write off when I rent a room out of my home?
It's going to be proportional, yes, but it's going to be proportional. Like if you rent out a room, are you able to write off like all of your utilities? No, that doesn't make sense. Like that's not going to be, but anything that you're using for your house or anything we're using for the rental, you're going to be able to take, but proportion to
Nice.
the income.
Nice. Okay, great. Alexandra is asking, when you take bonus depreciation, is there recapture if you sell within the accelerated period?
So there's recapture when you take depreciation, full stop. If you take depreciation, there's going to be recapture, whether it's bonus, whether it's special, whether it's regular, there's just going to be recapture. And this is kind of one of the reasons why I say depreciation is your best friend and your worst enemy. And so if you are going to accelerate depreciation, and then sell within a year or two, why did we even bother why did we accelerate depreciation? Like, what's the point?
Good point. Yeah. And also, she was asking, how is bonus depreciation different from accelerated depreciation?
Accelerated depreciation is bonus depreciation. Accelerated depreciation is also special. It just means it's moving forward.
Gotcha. Janice asking, I travel to a rental property once a year to do maintenance and repairs. Can I deduct the full cost for the plane fare and also for the car rental and the hotel or Airbnb?
Yes, you can. I remind people there are good deductions and there are bad deductions. The travel, that's a great deduction. It's an amazing thing. Of course, let's write that off. Bad deductions are going to be things that go in your mouth and on your body. So the meals and things like that, yes, you can take it. Yes, take the meals. I'm not saying don't. But just, let's be cautious about the numbers.
All right. And John asking, due to depreciation, my rental is often at a loss. Is that a concern like it would be for a business?
No, most rentals are going to show a loss. That's a wonderful thing. It doesn't mean, we hope it's not a loss in your pocketbook. It's just a loss on the tax return that is very, very common unless you're doing Airbnb or your rentals by like a stadium or SoFi or something like that. You're probably going to show a loss, or you've had the rental for years and years and years, so depreciation is really, really low. But that's kind of the sweet spot. That's why we love rentals because it's a great asset holder. It holds your money very securely for a very long time, and it's tax-free income. The profit you make on that rental, 9 times out of 10, it's tax-free. You're doing it
Beautiful.
correctly, John.
Beautiful. Also from John, he's asking, what can you tell us about QBI safe harbor for landlords? I get different answers from everyone. I assume it's only on profit of a rental, but goes away if it's a loss.
Yeah, you don't get QBI at a loss. Yeah. But yeah, QBI is going to depends on what your income is and it depends where it's coming from. If you have other bits and if you're wanting to get a QBI deduction, which could be up to 20% of your profit, it varies in types of the income and it also varies if you're going to consider it a business. You might want to throw part of it as management to help with that.
Great. Sumner asking, can I write off expenses if I am a passive in my real estate investments?
Well, what does that mean? Like you're not you if you I'm imagining that basically you own like maybe 10% of a rental or something like that and you want to know if you can write off your own personal expenses. So if you own a property with a bunch of people or just with another person, your expenses are all going to be the same, and so you guys will share expenses. And so if you have $100 light bill that you're using for the rental or whatever that you pay for, that other person is going to get $90 and you get your $10 of it. And so when you own things with other people, you should not be paying for expenses directly yourself because other people are getting the benefit of that. And when you own things with other people, you should put money into the bank account or the partnership or whatever it is, and those expenses should get divided out from there so that you can appropriately calculate for that.
Mm. Claudia asking, can you write off unpaid rent from lack of payment until the point of eviction?
No, you don't get to write off on what I should have gotten. Like, because I should have gotten a lot of things. Like, I should have won the lottery.
I know, that'd be nice. Um,
Can I get that as a deduction? The lottery was huge. Yeah, no, you don't get to.
All right. We got some good deductions, not that one. Mark asking here, if each year you have reasonable expense ratios, but with depreciation, you end up not owing any tax. Can this be an ongoing thing? Is it a red flag to not owe tax on an ongoing basis?
That is the joy of what I encourage people to do with cost segregations. You can drop it down to a zero tax situation because you keep doing these cost segs, which is depreciation. And remember, if you're trying to get a loan, depreciation is added back. So your AGI, you don't even have to worry about it because it's depreciation that's taking it down. It's just such a beautiful thing. No, that's totally fine.
Yeah, that's how it's meant to work.
Yeah,
Tracy?
I do want to make a little comment though that yes,
Sure.
you might spark some people asking questions that might, go like, oh, okay, but if it's done on cost eggs and it's done like legit, it's very easy to make those people go away. And it's worth
Hmm.
it. It's worth it.
Mm. Okay. Yeah, because Tracy was asking something similar. If I've been showing a good profit on rental properties for the last few years, will it trigger additional scrutiny if I now, for this filing, show less profit or a loss than has been usual?
No, not necessarily. I mean, I don't know what How much is the question? If you're gonna, if you were showing $20,000 of profit and now you're showing $150,000 of loss, how is that loss being reported? $150,000 should be depreciated. How did you get to that number? Like, I need more info, but
Mm. Okay, well, you can reach out to Nicole. Her email's right there. Therese asking question, losses from from hurricanes Helene and Milton. I have a rental condo in Florida that was hit by both hurricanes. Do the losses work the same as the wildfires?
yeah, they do. It's
Okay,
all for the natural disaster.
nice. How asking Airbnb business, should it be filed with Schedule C or E on the tax return?
So to be able to make it on a Schedule C, you need to offer a daily service. That could be cleaning, it could be laundry, it could be excursions. They don't need to select the daily service, but it needs to be offered, and it should be somewhere that is completely visible. So you could put it inside your actual Airbnb posts or something like that, so that if somebody does come around and ask a question, you can easily show, no, I offered the daily service like that. And
Hmm.
so usually people do cleaning because you just
More
have
like a
cleaning.
hotel style of
Correct.
service. Yeah.
That's exactly what it is. They don't have to select it. You can charge for it. It can be an additional fee, but you need to offer a daily service to make it a Schedule C.
Gotcha. Stan asked, does the cost segregation depreciation get prorated for the months the asset is owned? So, for example, if I bought at the end of June, do I get the entire worth of depreciation or only the 6 months?
So cost six, you'll get that full value of it starting when you put it in service. So if you bought it at the end of June, it's going to be spread over that year from June. So essentially, you'll get the 6 months, because it'll be just that 6 months of it of when it was put into service, and then going forward. I mean,
Great.
there's also ways where you can include the whole year. It depends how what we're talking about gets itemized into it. So certain things will get actually a full year.
Hmm. Okay. Ferdy asking, can a loss in the LLC write off my personal tax?
And the loss, and yeah, because your LLC is going to flow to your personal. Yeah,
Yeah.
absolutely.
Okay, great. Um, when you purchase a piece of real estate, you pay one lump sum for the whole thing. How do you go about allocating those costs to the different items, like the windows, cabinets, for the purpose of bonus depreciation?
You get a cost segregation study, and a cost segregation study is going to be done through a license. What are they called? But it's a person that goes through and they itemize it. You can't do it yourself.
Great. Tracy says, I have not typically been issuing 1099s for contractors who I pay over $600. Am I treading on thin ice? How sticky is the IRS on this matter?
It really depends on how much we're talking about, but yeah, that's one of the reasons why I tell people about, like, you need to report all your income, because, like, just because you don't get a 1099 doesn't mean somebody's not going to 1099 you later. I'm not going to recommend that you do back 1099s, but go ahead. Yeah, I would 1099 people. It's a wonderful deduction.
Great. Thank you so much for all of the questions. We went through about 17 questions just now, like rapid fire, and that was amazing. Thank you for the concise answers. And then we did miss a few that are still in Q&A. So I know, Nicole, you have a hard stop and you have to leave. So we'll send the questions over to you that were not answered on this webinar so you and your
Perfect.
team can get back to some of those people. And as usual, everyone, you're going to get the recording and slides and Nicole's info. So keep an eye out for that. And as you leave, please take the exit survey and let me know what you thought about this webinar. We look forward to seeing you again soon. Thank you so much, Nicole.
Thank you for having me. You guys have a great day.
All right, you too. Bye.
Bye.